Hey friends, welcome to today's Singapore Market Digest. I'm Iggy from the Investing Iguana, and today we're looking at some interesting movements in the Singapore market. Let's kick things off with ST Engineering, a company that's making big moves with its future outlook. If you're not familiar with ST Engineering, SGX S63, they're one of Singapore's largest technology, defense, and engineering groups with operations spanning across aerospace, electronics, land systems, and marine sectors. The company just shared some exciting news at their investor day on Tuesday. Group CEO Vincent Chong announced that ST Engineering is targeting a whopping $17 billion in revenue over the next 5 years. But that's not all. They're also looking to improve their profit margins at a faster rate than their revenue growth, aiming for up to 5 percentage points annually above their top-line increases. Breaking down their revenue targets by segment, ST Engineering expects their commercial aerospace division to bring in $6 billion by 2029. Their defense and public security segment is projected to generate more than $7.5 billion, while their urban solutions and satellite communications unit aims to contribute $3.2 billion. These are ambitious targets that show the company's confidence in their growth strategy. The market seems to like what they're hearing. ST Engineering shares closed at $6.38 on Tuesday, up 1% or 0.06. This positive movement suggests investors are buying into the company's long-term vision. When we look at ST Engineering's performance in context, it's worth noting that the company has been positioning itself strategically in high-growth areas like smart city solutions, cybersecurity, and satellite communications. Their defense business provides a stable foundation, while their commercial aerospace segment stands to benefit from the continued recovery in global air travel. Next up, let's talk about Keppel DC REIT, SGX AJBU, one of the first REITs focused on data centers globally. If you've been following the tech space, you know that data centers are critical infrastructure in our increasingly digital world, housing the servers and networking equipment that power our online activities. Keppel DC REIT just made a significant financing move. Their wholly owned subsidiary, Keppel DC REIT Financial Company, has secured a loan facility of 50 million euros, which translates to about $72.8 million. This loan is guaranteed by Perpetual Asia in its capacity as trustee of Keppel DC REIT. What does this mean for investors? Well, this financing move suggests that Keppel DC REIT might be preparing for new acquisitions or expansions in Europe. Data center demand continues to grow across Europe as digital transformation accelerates and AI applications require more computing power. Despite this potentially positive development, Keppel DC REIT's units closed slightly lower on Tuesday, down 0.9% or 0.02 to 217. This minor dip isn't necessarily a cause for concern, as REITs can be sensitive to interest rate expectations and broader market movements. Looking at Keppel DC REIT's performance in the data center REIT space, they've been maintaining a solid portfolio of assets across Asia Pacific and Europe. Their focus on high-quality, carrier-neutral data centers has positioned them well in a competitive market. From a technical standpoint, Keppel DC REIT has been trading in a relatively tight range recently. Investors should watch for any breakout signals that might indicate a new trend forming, especially as more details about how they plan to use this new financing become available. For those who might not be familiar, Grab started as a ride-hailing service, but has since expanded into food delivery, digital payments, and financial services across Southeast Asia. They're headquartered right here in Singapore, but operate across multiple countries in the region. According to Bloomberg, Grab has begun due diligence on GoTo, evaluating the Indonesian company's accounts, contracts, and operations. Both companies and their shareholders are also assessing the potential structure and value of an agreement. While talks are ongoing and may not necessarily lead to a transaction, this development is significant for the regional tech landscape. If this acquisition goes through, it would create a dominant tech platform across Southeast Asia, combining Grab's strength in Singapore, Malaysia, and the Philippines with GoTo's dominant position in Indonesia, the region's largest economy. The potential merger would bring together ride-hailing, food delivery, e-commerce, and fintech services under one roof. From an investor's perspective, this potential deal represents Grab's ambition to consolidate its position in the competitive Southeast Asian market. Since going public via a SPAC merger in 2021, Grab has been working to achieve profitability while maintaining growth. The strategic rationale for this move is clear. Indonesia represents the biggest market in Southeast Asia with its population of over 270 million people. GoTo, formed from the merger of ride-hailing giant Gojek and e-commerce platform Tokopedia, has deep penetration in this crucial market. By acquiring GoTo, Grab could significantly expand its user base and create economies of scale that might accelerate its path to profitability. However, such a merger would likely face regulatory scrutiny, particularly in Indonesia, where concerns about market concentration could arise. Competition authorities might require certain concessions or divestitures to approve such a deal. For Singapore investors, this potential acquisition highlights the growing importance of the city-state as a hub for tech companies with regional ambitions. Grab's moves could influence investor sentiment toward other Singapore-based tech firms and potentially attract more tech listings to SGX. From a technical perspective, the STI has been showing some consolidation patterns recently. The index has been testing key support and resistance levels, with trading volumes providing clues about the strength of market movements. Looking ahead, several factors could influence the Singapore market in the coming weeks. First, upcoming earnings reports from key STI components will provide insights into corporate health and outlook. Pay close attention to forward guidance as companies navigate the current economic landscape. Second, global central bank decisions, particularly from the Federal Reserve, will continue to impact Singapore stocks. Any shifts in interest rate expectations could trigger market movements, especially in rate-sensitive sectors like REITs and banking. Third, developments in China's economy will have spillover effects on Singapore. As one of Singapore's largest trading partners, China's economic performance directly impacts several STI components with significant exposure to the Chinese market. Finally, keep an eye on oil prices. Singapore's offshore and marine sector, including companies like Sembcorp Marine and Keppel Corporation, remains sensitive to energy price movements. That's all for today's Market Digest. I'm Iggy from the Investing Iguana, reminding you to do your own research before making any investment decisions. Until next time, happy investing!